With the markets going down quicker than Amber Heard's reputation,
why the fuck you lying? Why you always lying?
I thought now would be a good time to do a stock analysis on one company that has dropped recently, and that is Cisco. Now, Cisco is a company engaged in networking, and at one point its market capitalization was 569 billion, which made it, at one point, the biggest company on earth. And oh, how it fell from grace.
Continuité d'homme.
The dot-com bubble saw Cisco come crashing down. As it went along for the next few years, it ran into countless issues as it tried to do too much at once. Like when they tried to switch their business model and go international all at the same time, which then led to them cutting a bunch of their workforce to cut expenditure. But what is Cisco like today? Well, like I said, Cisco has now reverted to what it's good at and is engaged in developing, manufacturing and selling networking hardware, software, telecommunications equipment, and a variety of other services and products. So a quick introduction of networking, if you're sitting there thinking, what the fuck is this guy talking about? Don't worry. Networking is just the process of connecting different devices together, such as your computer to your printer. And the internet is just a giant network. You can think of it like this. If you went into a library and wanted to find a certain book, you'd have two options. You could either go around the entire library and try and find it yourself, which is time consuming, or you could get the librarian to do it. The internet works exactly the same way. You'll sit at home, type in whatever you want to search, and then things called spiders will then go out, fetch that information, and bring it back to you. That is how the network of the internet works. Cisco is also engaged in more modern networking, such as 4G and 5G. So as you can see, networking is a huge part of the world and how we live. So now we know what the company does, we can move forward with that knowledge and analyze the company's performance. So just looking at the price history and performance, we can see all the way back to the year 2090. So this huge spike here was the highest peak it got to, and then it had the dot-com bubble at 2000, and then we saw it come crashing down. This is where everyone was getting hyped about the company, thinking it was going to stay at all this high levels, but as we can see, it didn't do so well in the crash. Fluctuated through the years, up and down a bit, and then coming back to recent times, we can see that it peaked recently at $63.42. So that doesn't even get close to the peak it had there of $80. And then more recently, coming into the 2022, we can see it's dropped down recently to $43. Now this valuation as at now is actually quite good. If it dipped a little bit more, it'd be even better, but I feel if you look at the trajectory of the line, kind of picture one from here going up, this is quite a good support line there. So this company doesn't have massive growth, as you can see. As long as you buy at a good valuation, then it's pretty solid and stable company. According to Simply Wall Street's analysis, it is 54.2% undervalued. Obviously I'd suggest doing your own valuation to see if it fits in with your risk profile, but they calculate a fair value of 98 and the current price being 45. Now the 98, that's higher than the highest peak it had in 2000, so I do not think the fair value is 98 at all. I think the current price is actually a good price to get in, but yeah, I think that this 98 is not it for me. The biggest problem I see with this company is its future growth. Because it's such a large company now, the growth element isn't there anymore. As you can see, this company's been going around for quite a long time, and its growth is considered to be quite slow in the years to come. So you can see the earnings and revenue growth forecast here. I've turned on free cash flow and cash from operations. Going forward to the next few years, you can see that it will grow in a steady line according to their predictions, so it's nice to see they do think it will grow. Obviously some growth is better than none, and with the company's balance sheet and financial health, you'll see this is not too much of a risk. So you've got the forecast annual earnings growth of 5.2% and a forecast annual revenue growth of 4.3%. Both of these are below the market and industry. They calculate the future return on equity to be quite high, with the company being at 30.8% versus an industry of 13.9%. Looking at the past performance of this company, you can see things are really flat, to be honest. I've turned on every metric I can here. There has been growth. You can go here where it has all the data, and you can see free cash flow of 12.69 billion, whereas now it's 13.55 billion. So it is going up. Revenue, the same story, 4.9 to 5.1. So it has gone up over the years, has done some fluctuations over time, but if you're a long-term investor like I am, you're just looking overall growth really. So for me, this is okay. It has got growth. As long as it continues to do this going forward, even if it's not much, I would be happy with it. The company itself has done better than the industry in a lot of regards to managing. So return on equity has been better for the company versus the industry. Return on assets has been better for the company versus the industry. And the return on capital employed has been better last year than it's 3 years ago. So it is doing well at managing what money it does, which is nice to see. Now, where this company really shines for me personally is its financial health. You can see here all the ticks. So we'll go through this now. So you can see the short-term debts, long-term. So we've got short-term assets outweighing its short-term liabilities, and the short-term assets actually do outweigh the long-term liabilities. So that is just a massive plus right off the bat. Any debt it has to get rid of, it can easily. That is a huge win there. You can see the debt to equity history down here, like internal cash equivalents as well. So you can see that things have been going down throughout the years, sort of peaked around 2018 and it's been going down since then. But we can see that both cash and equity have been bigger than the debt at all times. So as long as this continues, there's no problem here whatsoever. And you can see here has more cash than its total debt. Major win. Debt to equity ratio has reduced from 49.7 to 23.3 over the past 5 years. Another huge win. The debt is well covered by operating cash flow. Another huge win. And the interest, companies always get the best interest anyway, so it's not a concern. And then you can just see here cash of 20.1 billion and debt of 9.4. So you're looking good financially in the health department there. Now, if you know me, you know that I am a dividend investor. My entire portfolio is built around dividends. That is just what I like to do. So this company is one that I personally do invest in. As you can see, it does pay a dividend of 3.37% here, it says. You can see the stability and growth of these payments, and they have been going up, the dividend per share, over the years, which is always a good sign to see. And with the recent price drop, the dividend yield looks more attractive also. The payout ratio looks comfortable at 52%, and we've seen with its debt and cash levels that it doesn't have a problem with free cash anyhow, so having this payout ratio be 52% is fine, and I feel comfortable with it personally. Okay, so now on Trading 212, this financial summary is always good to look at. You can see where the company's going, so we can see that it is increasing in different departments there, so you can pause and read this for yourself if you want to. I'm interested in all ratios, per share data, and if I scroll down, we like to see the free cash flow per share. This is trailing 12 months. So you can see it has $1.74 in free cash. Dividend per share it pays out trailing 12 months is 1.48. So we have free cash flow while paying out this, so we are fine in that department. We can go to financial strength and again just see the free cash flow, the trailing 12 months of 7.33 billion. So again, we are clear. And the other one I like to look at is the dividend growth 3 years, which is 6.51%. So again, for me, that is fine. Now, if you go into the income statement on Trading 212 for Cisco, there are some things to note. Obviously, this time period from 2019 as 2021 here, obviously we've had a few issues in the world. And I'll talk a bit more about that in a minute when I talk about the future of Cisco. So we can see total revenues of 51.9 billion in 2019, 49 in 2020, and then it goes to 49.82. So there is a decrease from 2019 to 2021. Not majorly, it's hovering around the same range. You can see the same in gross profit, 32.67, 31.68, and then 31.89. So there's a nice bit of increase there, but again overall it is a drop. And then you got the net income down here, 11.62, 11.21, and then 10.59. So again, it's not great to see that going down. The quarterly view I think looks about the same, 12.8, 13.13 and 12.9. Okay, so tiny bit of growth over those total revenues to now. Gross profit 18.19, 18.34. Oh no, 8.19, 8.34 and 8.05. So that's a decrease there. Net income 2.86, 3.01 and 2.98. So again, a bit of decrease there. Now, why is this? That's what we're going to explain now. Okay, so what's been going on with Cisco and what does the future look like for this company? Well, obviously we've had the sell-off of pretty much everything, with everything going down, fears of inflation, war, we've had COVID going on, all of that shit. It's not been good for the market in general, so the company has suffered that way as well. But again, in terms of other things going on, all those things I just mentioned affected supply chain issues, and that's one of the biggest things happening to Cisco now. If you're into PC gaming or things like that, you'd know that graphics cards were really hard to get, the prices for them were going through the roof, and that was to chip issues. There was a shortage of them, they couldn't make them fast enough, they can't ship them out fast enough. All the ports are backlogged with freight, and China has been hit heavily with requests to make more faster, ship out faster, but it just can't keep up. So that's basically one of the biggest things that's happened to Cisco. They literally can't make their products without the chips. Again, you'll see this in cars as well. If you've ordered a car, a lot of these newer cars have loads of chips in them, and there'll be pieces of the car that don't operate as they should because the chips are missing. It's the same thing there. Now, this does present quite a large issue because there's a backlog, like I said, so how are they going to get the chips to solve their issues? If they don't solve it, obviously their financials will just keep going down. They won't be able to make the growth, they won't be able to make their profit. So, Intel is another company that makes chips, and they are planning to set up a warehouse, another one in the US, to build a ton of chips. However, this is going to take quite a long time to make. So I would suspect Cisco would then buy from Intel and make use of their chips because it will be in their country, easier to get, shipping would be not an issue. But then again, that would then drive up price because in-house production is a lot more expensive than buying from overseas in China, where it's basically slave labor. So from what I can see, the future of Cisco mainly relies on software and 5G technology. These are two of the biggest things that will help Cisco now. With their supply chain issues, if they can double down on this and focus on this, it'll make it easier for them. There are a few uncertainties with the company, like I said, the main one being the supply chain issue. Their financial health is so good though that I think they'll be okay, and if they can just keep getting a steady supply. I mean, the financials you saw there from 2019 to 2021, we've had the COVID situation there, we've had the supply chain issues, going through all of that, and they still remained around the same mark. Dropped a little bit, but if they can just continue to do that, then there's not going to be much of a problem anyhow. So my personal opinion, and again, I'm not a financial advisor, I do not want to try and sell anyone any kind of stock. Cisco is one that I have invested in, and I do invest in regularly. At this valuation, it looks attractive to me. As a dividend investor, I see this as an opportunity for me to buy in to a company that I believe in long term. Doesn't have the most growth, but slow and steady with a healthy financial balance sheet. That is good for me. So I hope you enjoyed and got some value out of this video. It's very hard to make these kind of videos be entertaining yet educational and deliver the information in them. So if you have any ideas of how I might be able to improve that, I'd really appreciate it because I kind of struggle to make these videos sometimes. But yeah, thanks for watching. Check out links in the description, like, comment, subscribe, all that good stuff, and I'll catch you in the next one. Peace out.
Tell me pretty lies, look me in the face, tell me that you love me.